Hi, everybody. Welcome to the pre-watch session on a fantastic topic called as working capital management. Now, this topic is very different from the other topics of financial management. So you may want to take this up from a different perspective. This particular topic of working capital management is the most hands-on, most business-like, and something that keeps these firms such as an HUL or a Nestle, Britannia, Asian Paints busy every day. Every day, firms don't think of buying a new machinery. Every day, firms don't think to pay dividend. Every day, firms don't think to take a loan. But every single day, every single hour of that day, firms think to optimize something called as working capital. Every day, the CEO and the line managers, both of them, and everybody in between worries about the working capital management. So here I am talking a bit of the overview of what is going to be included in the sessions on working capital management. Okay. Now, this topic, like I said, is very operational, very hands-on, very business-like, is going to be learned better by all of you only when you have a business in mind, which you can visualize. So, for the sake of, uh, sake of clarity, sake of easiness, um, I'm going to talk about Tata Motors as a case. I mean, why I picked up Tata Motors is just a random thing. Perhaps, Tatas are doing a great job with their cars these days and, stuff like that. Also, we are very fancied by the cars that we have, and everybody can appreciate a car manufacturing model. Okay, let's say, an IPL is a very complicated model. Rummy 11 is a very complicated, but car manufacturing is a very simple, straightforward model. Manufacturing firm. Okay. So just imagine what kind of a factory would a Tata Motor be looking like? What must be happening in Tata Motors on a daily basis? If you're able to do all of that, then the next 10 to 12 minutes are going to sound much more logical to you. So allow me to share my screen and right here. All right. So working capital management, like we follow the practice of divide and rule, is actually the management of something called as working capital. Now, if we understand what working capital is, it will be much easier to talk about it. So, majority of my discussion today is going to be on what is working capital after all. And further, if I bifurcate, working capital is after all a capital but not fixed, but working. So there are two types of capital that a firm may need, a fixed versus working. Okay, don't take too much stress. Okay, I'm going to kind of help you visualize these things and connect the dots, because there's another important aspect of this topic. Uh, because most likely you're going to be looking at this video after finishing your financial accounting course, in which there was something called as a ratio analysis that you would have done. Within ratios, there was something called as liquidity ratios. And within liquidity ratio, there was something called as a current ratio. Now, current ratio is nothing but your current assets divided by your current liability. Okay, so it's a divisive thing. So you are dividing current assets by current liabilities. Okay, and let's say a number comes out as 1.75 times, which means for every $1 of current liability, the firm has 1.75 times of current assets to pay them. So in a way, it's a liquidity measure. Will the firm be able to pay their day-to-day short-term obligations, and is there any stress around that thing? Okay, so I'm going to connect this whole liquidity conundrum, the confusion, with this working capital management. And therefore, I say that sometimes this topic also becomes little irritating to be absorbed because there are too many dots that you're trying to connect. Okay, so let's go easy, everybody. Let's go easy. So how do you think a Tata Motors factory is going to look like? Some random pictures I have picked up. Of course, there could be, a picture of a worker working. There could be a picture of some kind of a truck getting loaded with the cars that are being manufactured. But in very simple terms, the first image that I have here is of a raw material. For a car, you would imagine steel coil is a very basic material, primary material. So let's say a POSCO steel or a Tata steel or a Nippon steel are going to supply these coils. And for Tata Motors, they will be called as quote unquote raw material. They're going to hold raw material for some time. So as you can see that the steel coil are not being directly shipped to the production line. They are being stored in a go down for some time. Okay, there is, let's say, for 5 days, 10 days, 2 days. I don't know what kind of a inventory management system does Tata Motors have, but for some time they will be on the in the raw material go down, from where they are going to reach the production line. And sometimes we use the word factory or a manufacturing location to signify this. So this is my production line, where the same steel coil is going to be transformed using a weld shop, paint shop, assembly shop, not getting into the technicals of the production, but you can imagine the conversion of raw material into finished goods is happening at this stage. So you have a raw material becoming a finished goods, and in the process, there would also be a lot of WIP, work in process. And you see this car is not fully built, but it's not fully raw as well. So if you can appreciate, a half baked pizza is neither a full pizza nor it's just a piece of dough. So it's a WIP, work in progress. So this is what the second stage is. And once the car is final, it is not immediately sold to the customer, or it cannot be, or it may not be sold to the customer from the line itself, and you have some kind of a finished goods stockyard where it gets stored. So that's the overall process that Tata Motors follows on a daily basis. Obviously, there are a lot of thousands of other transactions, such as hiring labor, paying to them, asking for consumables, buying paints, etc. So all those riffraffs I have tried to remove so that we can simplify a particular transaction of manufacturing a car, some steel coil being purchased, converted into a car, and then car being stored before being sold. So this car, when it will be sold to the customer, so Tata Motors, you and I don't buy from Tata Motors directly. So who's going to be the customer for Tata Motors? The dealership is going to be. So where you see the Tata showroom, that's where they are the dealers who buy from Tata Motors and they sell to us in turn. So the customers for Tata Motor as a firm is going to be the dealerships that we are talking about. So dealership will come and select the cars that they want and kind of pay later on. So that's a typical cycle. I'm using a word very carefully, cycle, and I'm going to give it a name later on. That's a typical cycle, that the firm follows on a daily basis. I also connect you to the concept of the operating activities, which again you have done in your financial accounting. Remember, operating activity, investing, and financing. So operating activities were those which the firm will do on a daily basis. So these are the activities that we are talking about right now. Okay, it's very operational, this concept of working capital. And while Tata Motors is into this whole process, into different stages of cycle, at any point in time, the clock will strike 31st March of a particular year, at which point the Tata Motors may have to make a balance sheet position as at a particular point in time. Now, here the point is, if somebody clicks a picture, how would you read it? Okay, perhaps you may want to pause the screen and read it through. Um, at a point in time, what are the kind of assets Tata Motors have? How would you read it? Okay, now, first thing, this is not an accounting session, so you don't have to look at it from the point of view of accountant. You have to look at it from the point of view of a manager. The data is accounting data, but the way I presented it and the way I want you to read it is very managerial. So how are you going to read this situation? There are two parts of the balance sheet, remember? The first part of the balance sheet is the application of funds, the asset side, sometimes we call it, which is the things, the resources that a business will buy. What has been bought? What did Tata Motors buy? Now, at this point in time, if let's say these are the kind of cycle that I have kind of shown to you, what do you think at a particular point in time Tata Motors will have? They'll have some raw material in form of steel coil. They'll have some finished goods, perhaps some WIP as well. So I'm just removing that line item. In total, there is about $300 of inventory. Then there are some dealerships. They have taken the car, but they are yet to pay. So these are called as credit sale typically. So you're selling your goods, finished goods, but the customer has not paid. So there are some, finished goods being sold at a profit, and the people are yet to pay. That's account receivable, also called as debtors, also called as trade receivables. That's the 400 number. And then there is a machinery component also. Don't forget that in the factory, you see all these are fixtures. You see these conveyor belts, you see these robots here, you see these racks here. They are also, they need to be invested in. So overall, if somebody asks me, the total amount that Tata Motor has invested in is a sum total of this, so which is about $1,700 dollars. Okay. Out of that, about 700 has gone into short-term assets and 1,000 has gone into a long-term asset. Okay. This is the way your financial accountant, we used to call it. Sometimes we used to call it gross block, and the other one we used to call it current assets, different names. But the long and short of it, that this 1,000 and this 700 are very different in nature. This is an important point of discussion. What is the difference between a 700 and a 1,000 at this point from the Tata Motors point of view? Some similarity. For acquiring both of them, you need to spend money. So therefore, in a context of a balance sheet, cash goes down and these assets will go up. Either it will be a raw material or it can be a machinery. That's there, okay, writing on the wall. So you have to spend money in order to acquire these, but still there is a lot of difference between them. The first and a major difference is, while you are talking about a long-term asset, you are essentially referring to something called as um, a fixed asset, which is a machinery, which is not to be purchased every day, which is not to be thought about every day. The decision whether to purchase or not is not a, let's say, a concurrent decision that you have to do it on a real time basis every time. Okay, so that's the first decision. There's the first difference between the two. That fixed assets, the decision is very, periodic. That after 5 years, after 3 years, you have to kind of look at it. Okay, the first difference. Second thing is, the second difference between 1,000 and a 700 is that the components within these headers are going to change. This is something super important, which is when we are looking at after, let's say, 3 months, when I'm going to look at the machinery, I'm going to find the same machinery out here. But in form of finished goods, when I'm going to look at the car, I will find a car, but that's not the same car that was standing here 3 months ago. In fact, that may not be the same car that was standing 3 days ago, which means there will be an internal rotation within each of these categories. That internal rotation is what differentiates a working capital or a short-term asset or an operational asset, any name called, with this. So there is an internal rotation. Okay, uh, within this 100 and 200 and this 400, every time, look at this diagram. Do you think the steel coil will stay here for after 3 months or 3 years? No, but you see this conveyor belt is going to stay here after 3 years also. That's the difference between a fixed asset and a current or an operational asset. The third difference here is a kind of decision that you have. In form of fixed asset, the decision is very binary. It's yes or a no, whether to buy the machinery or not, or buy something else. Okay, you can't buy 50% of the machinery, you can't buy 60% of the machinery. Think about it. When you have to buy the car, you have to buy it either fully or not. Okay, but in case of the other three components, the decision is not yes or no. If you've got the machine, you need to buy the raw material. There is no point about it. But the question is, how much? So the key question here that a finance manager has to appreciate about working capital is how much of the raw material or finished goods or these receivables one should have. So while we're talking about the working capital management as a concept, management means taking a decision, making a trade-off between the two. The trade-off in this context is going to be not whether to buy or not, which one to buy or not, but how much to keep. So a very simple analogy from our daily lives has been, let's say when you buy a car, the question is which one to buy. But when you put a petrol, the question is not whether to put petrol or not. The question is, should I get a tank full or should I get, like a 50% tank? And that's a matter of habit. Which one is better? Well, there is no one size that fits all. It depends upon a lot of factors. Same thing goes with Tata Motors. For a petrol example, if petrol pump is right next to my office or next to my home, I may afford to fill in smaller quantity every time. But if I have to drive on highways, then every time I fill in, I get a tank full. If the cars, is has a bigger fuel tank, then I can afford to fill in smaller. But in case my fuel tank is smaller, I need to get a tank full. So what I'm trying to say is it depends on a lot of other factors, the condition of the roads, etc., etc., the breakdown services that determine the level of petrol I buy every time. Similarly, for Tata Motors, it depends on a lot of factors. If my raw material supplier is right next door, I can afford to buy smaller quantity every time. But if my factory is in Gurgaon, North India, and my supplier is in, let's say, down south in Chennai, then I can't afford to buy five, six coils every time. Then I have to really get a full tanker out there. So it depends on a lot of factors. While we fix the optimum level of these short term assets. You see, every time I'm going back to the discussion of the short term asset, this is what the working capital is. Okay, let's just continue the whole discussion. So that's the asset side of the balance sheet, where what does Tata Motors buy? Okay, so the key question here, talking about this 1700, dividing it into two parts, fixed assets and operational assets. Operational assets we just saw are day-to-day, daily decision. They have internal rotation, and the question is how much. Let's look at the other side of the balance sheet. The other side of the balance sheet is who gave money to Tamo to buy these 1700 worth of resources. Remember, a business, a company has nothing of its own. They need money to do something. So on the other side, liability plus equity, as sometimes we call it technically in accounting, we have money coming from multiple sources. First and foremost is the equity shareholders capital, and I understand that you don't need a primer on that. This is the money, very long-term money, for perpetual money raised from the shareholders, the owners who have the voting right. 500 is the money, hypothetical numbers, of course, that I have raised from the the lenders, like a bank, like a bond market. So these are the people to whom I have to repay. There is a promise that I have. Okay. And these are my financing items, also sometimes called as capital structure. This discussion is or has already happened in the topic of cost of capital, where to raise the money from, debt versus equity. So this is the confusion. Out of these 1400s in total, how should the split be? Should it be 500, 900? Should it be 1400? Should it be 1400 and zero? That depends upon the financial engineering of the capital structure, and this is the whole discussion that we've had or we will have in context of cost of capital. Okay, now I want you to focus on this 300. Who is this fellow called as supplier who is helping me to buy these resources? On the other hand, this is an operational obligation. Operational obligation. Now understand this point very, very simply. 700 rupees you require to buy your operational assets. And then there is somebody who is giving you a credit of 300, which is okay. That fellow is okay that you pay that fellow later. How much money do you need at this point in order to acquire these assets worth 700? That's the question that I'm asking. Okay, perhaps this is sounding a little confusing. Okay, take it easy. if you go to buy a packet of chips, that packet of chips is worth 70. Okay, you need to have full 70 rupees in your pocket in order to buy that. Okay, so the simple transaction is going to be cash down from your pocket and chips will come into it. So it's a very simple, one asset will replace another asset. But imagine the grocery seller gives you a credit of 30. He says that no problem, pay me 30 later. How much money you must have in your pocket in order to buy something worth 70? The chips is worth 70. You want to buy that. And the fellow is willing to give you a credit of 30. You just need to have $40 in your pocket in order to get access to the chips, the quantity worth 70. That 40, which is nothing but 70 minus 30, that $40 is your working capital requirement at that point. So what is a working capital? Working capital is the money that you need to source from a bank or an equity to buy your operational assets, which is nothing but over and above the operational liabilities. Okay, so here we are talking about, let me share my screen once more. We are talking about a very simple situation that you have 1700 worth of total assets being parked, but that involves long-term asset as well. That's not the focus of the discussion right now. My focus is only these 700. And out of that, I am getting a credit from an operational obligation worth 300. That means I need only $400 or rupees, whatever, in my pocket to gain access to these resources. That is my working capital at this moment. Is it going to be fixed all days? Absolutely no. The moment you sell some goods or the moment, your creditors will demand some payment, all of these things are very, very volatile. Remember, I said it's a daily basis fluctuating. That was my first point here. It's a daily fluctuating thing. It's not like machinery or a loan where once taken, your life is at ease for next 2 to 3 years. Okay, so therefore, working capital requirement continues to go up and down every day. And on that thing, let me give this a name. It's called as an operating cycle. Remember, the second point that I just mentioned is that there is internal rotation, that today something is raw material, tomorrow is that it's the same thing is WIP, and thereafter the same WIP is going to become a finished product, and then the same finished product is going to be sold. So there is a particular, and that's the person who has bought it is going to pay in cash. So there is a full cycle, and then next day some other raw material will be converted into finished goods, and then that will be, so you see every time continuously the business is incurring multiple cycles. That cycle is called as an operating cycle. Okay, so in the live classes, we are going to talk about how to calculate operating cycle, and we are going to zoom into some of these things also. So okay, there are different types of working capital requirement. One is a permanent requirement, wherein you're saying that minimum this much amount I must need at all point in times. But you see, for a growing firm, the working capital requirement will also be higher. Just imagine that working capital is nothing but the amount of petrol that you're putting in. Okay, so for you as a household, car is a fixed asset, but the amount of petrol that you're putting in is a working capital. So how much petrol do you have at one point in time is going to be very different than the next minute. So that's the point, that it's an internal fluctuating thing. Okay, it's ever fluctuating. But you see, till yesterday you had a car with a 30-liter fuel tank. Tomorrow you upgrade to a bigger car with a 45-liter petrol tank. You see, your psyche is to get, let's say, 50% tank full. So here you were buying 15 liters and now you have to buy 22.5 liters. You see, your working capital requirement, you have to spend more for buying 7.5 liters. This 7.5 liters multiplied by the cost of the petrol, let's say 100 rupee. So this $750 is the gap that we are referring to. A growing firm will need to invest more into the operational assets also. It's not enough just to buy one more machine. It's not enough just to open up one more factory. You need to stock it well. And therefore, you need to spend on working capital also. So that's the gap between, the flat line, the permanent, and the growing firm. And then obviously we are talk more on these live examples in our live classes. Then there is a seasonal requirement. You see, during Christmas time or during a Diwali time or any festive time for that matter, you see suddenly the grocery store seller will have a counter outside and there will be a lot of gift items. Now, gift items, just imagine, is also needs to be procured. You need to have that much cash in your pocket. So how much extra cash do you need at that moment? That's a seasonal or a temporary working capital. So typically you need more cash, more cash, more cash, and then perhaps this is a time where Diwali is or a festive season is, and then you will clear your stocks and the temporary requirement is going to go down, something like that. Okay, so that will continue to keep on changing. So I hope that this overall session on this working capital, what kind of assets are we going to look at, raw material, WIP, finished goods, receivables, suppliers, there is some bit of clarity than what you had. We've tried to connect the whole concept of working capital with the balance sheet also, wherein we look at the current assets and the current liability, primarily the operational assets and the operational liabilities. And the difference between the two is what we refer to as working capital. The key point here, let me reiterate at the risk of sounding boring, is not whether to have working capital or not. It's very ridiculous a question. The question here is how much of working capital should one have? The two extremes, and obviously I don't want to make this video any longer, but the two extreme are I have very little working capital, meaning I have very little petrol in my tank. What it helps me with is keep the cash in my pocket. So my profitability goes up, but my liquidity is very low. I have very little amount of current assets with me to pay off any obligation. So this extreme, very low petrol for Tata Motors, very low amount of raw material, very low amount of finished goods. This extreme means that the liquidity of the business is good, but the profitability of the business is going to be a little tight. So all of that kind of a confusion is what we are going to solve into our live classes. The other extreme is that your godown is stuffed with a lot of raw material things, and you have a lot of cars already being built. So the advantage here is that you will be able to honor all the orders. Okay, so you will not lose on any sale. So that way, that end is going to be extremely profitable. But then you have to buy so much things. So you need to block your money. And therefore, from a liquidity point of view, that's not a good thing. So while having a lesser fuel in the tank is good from liquidity, it's very risky that way. So there is a risk and return set off also. So I'm just throwing some statements, not to kind of make this video a substitute of the live class, but to give you some thinking points. How much petrol should one put in? It depends. How much raw material should Tata Motors buy? It depends. So what are going to be those factors? What are going to be those set-offs? How do you quantify all of that? That's what you're going to see in your live classes. So I hope that this introductory video on working capital management has been useful. Your understanding is better than this. I will look forward to see you in the live classes.